Hello, friends. So, today there is an important topic that I wanted to talk about, and that is the macroeconomics as usual, important topic. And this is a very important video for everyone if you are, an investor and looking for the future, right? So, of what is going to happen in the market because there's a lot of uncertainty that is building up. So first to tell you that if you are someone who have missed out the COVID hyperinflation, then there is good news for you that the second cycle of hyperinflation has just started. And I say that because the treasury bonds of 10-year treasury bonds, which has the yield, which has been going down, has started climbing up. Now, when it goes, so from 3.8, it has now reached again back to 4.5%. Now, you might see that 7% difference treasury bonds that is in US. How do I need to worry about it? I mean, just imagine the treasury bond market. The treasury market is actually $27 trillion market. That's the biggest market in the world. And that is measure of our your US debt and all those things we are talking about. That is measure of this is with the bond market, right? Because US issues bonds and gets into debt and then spends and then inflates everything around the world. So hyperinflation is starting. The second cycle is started. Now this is the time you go and invest in real assets because the time has started. Now, what is the impact? So, what happens when the US Treasury bonds yields go up? So, my expectation is that if the Treasury market, the 10-year bond, if it the yield goes beyond, 5%, beyond 5%, then it start in the risk zone where interest rate goes up and then it has to go up. So what happens is there is a correlation between the US Treasury bond yield, especially the 2 years, and then your Fed funds rate FFR, which is your US interest rates, which is US target interest rates, which banks in the US has to lend to each other. Then they have to follow this rate, that is the target rate. So that is a interest rate for US, which defines the interest rate for other items like credit cards, even mortgage, and everything is defined by this. And US keeps on every 3 months or 2 months they meet FOMC and then they decide what is the interest rate. So the last time that there was a lot of market speculation that these US interest rates are going to go down and have been tending consistently since almost 9 months now. That is not going to go down. Everyone in the market is lying. The markets, the future markets are lying. The 10 Fed officials are giving you incorrect information. All the experts are telling you lies because there is no way the interest rates can go down. Some of them, in fact, even the markets have said that 6 to 8 times of rate cuts that they were speculating, and I was consistently telling the rate cuts would be zero in 2024. And so far, it is right that since then there had been no rate cut, and I have been telling that in fact instead of the rate cuts, it can actually increase the rates, and that is what going to happen. And the cycle has started now. That interest rates going to go up because as the yields goes up, the treasury bond yields goes up, the interest rates has to maintain the parity. Otherwise, what happens is people will buy from the Fed and buy and deposit in the treasury bonds, making the difference between that gap. So they are taking money from Fed from one pocket and putting other market and making money. And that is what some of the schemes of Fed has actually done that. And but then this is a very big market, so US won't do that. So there is always a market where people there is a demand and supply game. So as the treasury yields goes up, interest rate goes up. Now what happens when the interest rate goes up and this treasury bond yields goes up is that the cost of servicing the debt becomes high. So anyone who has taken mortgage loans, anyone who has taken business loan, or anyone who has taken put the money in a safe asset, their assets is not safe because if you hold the treasury bonds thinking that it is a safe asset, the value is going to go down, then it is your safety is reduced, and that is what it is. And that is one side of it. And when US increases the treasury bonds yield rates, the other countries has to increase it further because otherwise people will prefer US because it's more triple A prime rated bonds than the other currency bonds, other countries bonds. So for example, Sri Lanka is there, they issue also bonds, so they have to raise further, because otherwise, if US increases this much, then they have to increase little bit further. Otherwise, there are no takers further. So globally, all the countries will start increasing the yield bond yield rate. So India, for example, 7.2 or 7.5% is the interest rate which we have given issue 50-year bond this year, at the start of this year. So that will go up because then there will not be any takers for at that rate. So similarly, India plans to issue 14 lakh crores worth of bonds this year. This is regular bonds. Apart from that, there will be sovereign bonds. Apart from that, 50-year bonds and all those things. Now, we are not even talking that regular bonds, 2 year, 5 years, 10 years. These bonds, India is going to issue 14 lakh crores debt that they are adding just on the bonds. Now, when they issue, as the treasury yield goes up in the US, they also has to increase this yield bond. Now, when government increases the yield bond rate, they will also see that their cost of servicing that debt, bond issuing bonds is a debt, right? So the cost of servicing that bond is all that is also increasing, which means they will collect more taxes because they have to pay more interest on these loans. Already we have huge loan piled up, so further increase in this will increase the taxes, will increase the interest rates. RBI is going to go and increase the interest rates to contain the inflation which has been exported from the US. So these interest rates of your mortgage, your home loans, and your personal loan interest, your car loans, everything will go inflated. And that cycle has just started. This is the second cycle that has started. And you might say that what is that bonds they're gonna issue, they're gonna renew it. What is it? It's a normal process. But then at the start of the year, 2024, $8.2 trillion of bonds were expired, and that has to be renewed. But now already 6 months gone, and some of them they have already removed. And when you look at the next 12 months, that is the next 1 year, again $10 trillion of bonds, 9.8 or something, it's around $10 million of bond is expiring again. And US, who's going to take these bonds? No, no other country wants to take it. No foreign countries wants to take the US Treasury bond because they are losing faith on that, right? Because the yields are increasing and then their value is decreasing. So no one wants to hold in it, and no one has trust in the US dollar anymore. So that is why Japan, China, every country is dumping. Now there is another game that is happening. That is which I will explain it. But there are no takers, and Fed will be forced. U.S. Federal Fed Department will be forced to take in the bonds, buy the bonds in the local market at a higher interest rate, even if possible. So that is why the yields go up. And here's comes my biggest prediction, that speculation, you would say, that because the biggest holders of these bonds is not the foreign countries, but or foreign governments or foreign banks. It is the retirement funds, it is the pension funds, it is those insurance companies, large government government state companies, which are actually taking the US debt, and then they are keep on renewing under certain guidance. Now, some pension funds or some insurance funds or even mutual funds, we don't know, they might be asked under the table to take some money and keep on buying these assets, this US Treasury bond, because they are no takers. And this is just a speculation, but it can happen because anything can happen when things are not sellable, right? The last, if you see that this year, 80% of the treasury bonds that I sold is only short-term bonds, which means US is not able to sell long-term bonds, and inability to sell that long-term bonds is a risk because it's going to come again after 2 years. So if you sell it to somehow 2 years treasury bonds, then again 2 years after that again it expire. So 30% of the bonds, 70% of the bonds which are already in the market are in wetting, which means they are newly given. So they are going to expire soon and again come back. So this cycle is very fast repeating, and there are no buyers for it. So obviously, some mutual funds, some pension funds will collapse because they will be holding those bonds, and that bonds market will collapse. So it's going to burst. So the dollar market and the bond market is going to burst soon. Now coming to the dollar, now what is happening in the dollar, because these are all connected, right? So macroeconomics, when you are reading, you are looking at the bond market, you are looking at the gold, you are looking at the US, US dollars, and then the big currencies and all those things, and the economy as a whole, right? So let's move on from this market, from this debt market to US dollars. Now, what is happening? US dollar reserves. Every country wants to maintain a reserves of US dollar because the trading has been happening. Now, the petrodollar uh, contract is done, 50 years over now. Saudi Arabia has cancelled that deal, so has closed that deal. So no more trading of mandatory trading of oil only in dollars. So that requirement is gone, and many countries are bilaterally doing trades without the use of dollars in the local currencies. Now, what is happening in some of the countries that they are announcing gold-backed currencies, new currencies, and that's going to happen in India also. That is another speculation I have, that India is going to launch a new currency soon based on gold, and that will happen after the gold price increase. And I am going to come on that, right? So, so that's on the currency side. Now, US, now China. Look at China. What it is doing? China has still has 700 to 800 billion dollars of reserves, US dollar reserves. Now, if once it can dump it and start buying gold, it did it already in the last 4 5 years. It has been doing that, and then it has dumped. Now, why is it stop dumping this remaining? There is a reason for that, and that is the game. That is the biggest game that is happening right now. Is that China has been dumping the dollar and buying the gold, but it has might have changed the strategy that it now started uh, not reporting the gold buys. Since last few months, it's not reporting any gold buys. So while India bought, China is telling that they have 2,300 tons of gold now, but the speculation in the market is could be 10 times or even 20 times more, and China is actually taking loans, which is issuing bonds and actually buying the gold in the market. They are mining, and they are directly buying from the miners, and that is why it is not pushing for the de-dollarization as faster as it was pushing last 1.5 year ago or 2 years ago, because then the gold market goes up drastically, and then they can't buy more gold because they want to buy more gold cheaper. So that is why the game is. And IMF has been reporting that China is not reporting the gold buy, and but it is buying in the gray market, and it is not reporting. So that is what is what gives us a clue that what is going to happen in the dollar market. Dollars will be dumped any day. So people think that once the gold reserves and everything is gone, then only people can dump the dollar. No, the actual game has started, and I believe that dumping of dollars will be some of the last stage. Before that, they will keep on showing that this dollars is still with everyone, so it cannot collapse. And then in the back end, they are actually taking more loans and buying gold and accumulating gold and keeping it for the reserves, because the new currency, which is unit, you might have heard this, but there's a new currency with BRICS nation that is starting with its unit, and that will have 40% mapping to the gold. So 40% of the currency will be based on gold. So that is huge number. And China, Russia, Germany, and all these countries who have a lot of gold and are accumulating daily. Even Switzerland is doing that. So these countries wanted to buy as much as gold first and then declare that. That is why they are doing the slow process, and I think that is a very good beneficial to them. The US might have already realized that this is the game that people are playing. So we don't know if US is also starting buying. But the last time US reported that they have 8,000 tons of gold, which is the highest in the market of all the countries, is the audit has not been done since 1954. So nobody knows, no one has seen, or it has not been publicly audited about how much gold they have. So are they having more? Are they having less? No one knows. But in papers, it is still 8,000 tons, which is 3 or 4 times, 2.5, 3 times bigger than what China is reporting, because China, Germany, Russia is all reporting only between 2,000 to 3,000 tons of gold. India is also reporting 800 tons of gold. But then, we have been accumulating, though we are showing the numbers that it is the fastest accumulating, but people are doing behind the curtains, many countries. and I don't know, we might be doing or not, but I don't see that we doing it because there's a lot of funding that is happening on the infrastructure side, so I don't see. And also the concessions, mining concessions, all those things, the corporate lending that is happening from the government side. So I don't see that much of gold buy. And even when I look at the numbers of this year, 30 tons is what India bought the gold. But that number, when I convert it to crores, it's not much compared to our loans. We are talking about 14 lakh crores loans, and then this number is very pale. So we are not doing enough, and I'm afraid that our gold reserves are only 10%, whereas our reserves in dollars, 60% is all is in US dollars, and that is worrying because we have to move fast. Come out of this, because China can do that any day. We can't do it. China is a highly export oriented country, so they can do anything any day, faster pace, which we can't do. So that is why the game China is playing, we can't play. So we have to completely forcefully shrug off this. Government has to shrug off this, US dollars, and go with the gold currency. Uh, Buy gold in the market and accumulate a lot of gold. So what India is banking on, why there is lesser risk on India, is because India is not banking on its own policies. It is banking on the public, because Indian public has 14,000, is reportedly having 14,000 tons of gold, which is almost double to what US holds. So US government holds, right? So that is what people are banking, because anytime the government, Indian government come and say that, hey guys, whatever you are holding, go and come back and deposit in India in your RBI, like how the demonetization happened, degoldization can happen, and then they will ask you to deposit back the gold and take the new currency, and government comes, gets all the gold. That's what US did when they announced the dollar. They announced that no one should have gold, and then they should deposit back. I mean, beyond a limit, deposit back that gold into the US Federal Treasury, and then take the new dollar currency. That's what they did, and India can also do that, or another countries can also do that, and it is on the cards. It's going to happen. It's just a matter of time. So the things are moving very fast, guys. I'm telling you, hyperinflation is coming. If you don't be in the money market, your time is till Diwali, this Diwali, come out of your stock market, because on Diwali or around Diwali, there can be, that is October, November time, there will be big announcement on this BRICS and this gold market. It's gonna come. So because there is a big meetings which are lined up and things are already in place, and so money markets can any day fall. It's keep on rising because the debts is rising and the bond renewals are happening. Pension funds are pushing it, buying it, and Fed is buying it and trying to pump up this market. But the balloon can burst any day. US can also declare it before this China, Russia, and all these countries dump it. And to tell you the risk of these big countries, people might think BRICS, what is there? Yeah, few countries, they can't change anything. 59 countries are ready to join BRICS today. Now they are ready to join BRICS, which means it can create a havoc in the gold, in the US dollar market, the treasury market, the biggest market, and also the gold. So if they join the big currencies, they are talking about a few currencies which will be bucketed, or some new currency will be added, and then this 40% gold backing is what it will be added in that as a reserve currency. So if that happens, then there will be gold will be gold, obviously, because you have to keep holding the gold. So if you are in the stock market, money market, if you are invested in mutual funds long term, don't do that. I suggest seriously, my my recommendation, my speculation is that these mutual funds houses, the pensioner funds, and all these are the things to give you assured certain percentage of result. They they get into certain investments which are high risk, and certain investments which are triple A rated, and treasury bond is one of them. And we don't know what can happen behind the curtain, and people will get stuck in these treasury bonds, and it is big money. It's big money. What happened to SVB can happen to any pension fund. It can also happen to asset management companies, or these mutual funds, or things like that. And even this gold, virtual gold, this whatever the paper gold that is there, not the government bonds but ETFs or whatever. uh, Everyone start taking delivery of the gold, silver, and all. There is not enough gold that is traded. I think someone said that there is a 14 times of trading that is happening on what is the actual physical gold. So if someone calls for the, actually everyone calls for the delivery, then there is nothing actually. So it can balloon, it can fail. Lot of things can fail. So my suggestion is go for real estate in tier 3, tier 4 cities. Be safe. Hyperinflation will be there. Your assets will triple or four times it will become. Make use of that money that way and invest it with gold. Gold is an investment, no more a hedge. I have been telling it is a hedge, but now it is not the hedge. It is the investment. Since last 6 to 8 months, I have been telling that gold is no more a hedge. It is an investment. Go and invest because it can go anywhere. And if US publicly starts telling that, I will also start buying gold, and then does an audit and show that I have this much of gold, and then this, and then everything will be backed on gold. Then every country going for gold. The gold prices can go. So the game can be opened up any day. It is already happening behind the curtain. People are not declaring. They have been declaring, and the gold price has gone up. Now they stop declaring, but behind the curtain things are happening. So gold will again balloon. It can create a havoc in the market. The money markets can burst. Lot of this money we are not talking. We are talking about what, $2 trillion deficit every year. U.S. government. I mean, you had $22 trillion of debt just in 2019. Now you're talking about $35 trillion debt. Paying $1 trillion of this interest every year. These are not sustainable. This dollars, this de-dollarization, de-treasurization, this currency reset. These are all going to happen. It can happen anytime. The people are not interested in pressing the button because this is one time in a time opportunity. They want to go deep in the opportunities. Countries are going deep in the opportunity and cashing as much as you can. You can also do that. Governments are doing it. You can also do it. Go deep in it. Get buy lot of gold. Buy lot of real estate. Don't get away from this money market before Diwali and get into safer haven. Safer havens is no more a triple A bond. Anything that is in paper is not safe anymore. And I can tell you things can burst. And even if it doesn't burst, don't tell that Ram you said by Diwali things will burst. It has not burst. In fact, it has doubled. It can because there is a lot of currency coming in. It can, but the risk is not the same. The risk you are playing is not the same. But on the other side of the risk, there is a lesser risk, more probability, more chances of making money. Even if you make a lot of money in the stock market, you come out, your value of that money cannot purchase the same thing that you want to purchase, you would have purchased 1 year ago. So it's not going to be there. So try to understand this thing very clearly that real estate is real. Gold is the main investment that you should focus on. And if you can't buy so much of gold, physical gold, go and buy in real estates, especially tier 2, tier 3 cities. Don't depend on the stock market. Come out of it by Diwali. Especially large caps only, you can depend on that too. I would suggest honestly, don't get into that SIP mode of mutual fund. If possible, come out by Diwali. You have time. See what is that you can do, and come out of it. And if you have taken loans, try to convert those loans to fixed loans because interest rates going to go high. See what options. If it is 1% is what you're gonna pay extra, pay it. It is better to be safe than being sorry because the rate's gonna go up. Be safe. And if you do that fixing, then you can also play the other risk game with other money. So this is called hedging that risk. You hedge the risk by just fixing your interest rates to a specific fixed percentage. That's what people did in the US market, and then now they are safe. So and people think that interest rates, 2% interest rate, what will happen to me? Well, I can tell you interest rate can even double. You don't know. Yeah, you can't put a cap to it because there is no cap to what US Treasury yield bonds will move to. There is no. If it can keep on going up and countries can go bankrupt, and people who have taken a lot of mortgage loans can also go bankrupt if you're not properly planned. So I'm asking you to invest, but be cautious on how much loan are you leveraging on a floating interest rate. That is very important because that might balloon. Asset values definitely will go up, but you have to see that your interest is not eating up consistently that thing. So either you pay up. Now some people will say, I have the money, can I actually close the loan? Yes, you can close the loan, but this is a decision you take now or in 6 months. It's because in 6 months interest will go up, and then the decision will be, many people will take is closing the loan. So you can take now or then, but then I would suggest you close it if you don't have the risk appetite. But being in cash, sitting on cash in FDs, in money market, in the share market is a risk. Avoid it. Avoid it. I'm telling you, just avoid it because many people don't agree with me. I mean, this has been happening for Chinchulwalas since centuries, 50 years. This is now 50 years it has been happening. But this game is different. I mean, the dollar game has been running. There is a stop to everything. So there will be a reset. There will be a reset. The currency, the see, you have to understand that stock markets are back with fiat. The fiat currency is in danger. When the fiat currency is in danger, stock is in danger, because if you sell the stock, you get the fiat. You don't get the gold. You don't get a real estate for that. So you have to understand this is in danger wherever it is, whether it is in FD form or investment form, mutual fund, pension fund, retirals, insurance, or wherever this fiat is, that is in the danger zone. And that danger can materialize any day. So please be careful about it. Keep following my news, keep reading the news, and thank you so much for watching. Jai Hind.